The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
In 1887, the first law establishing the C.P.A. designation was enacted. Hi, I'm Scott Cheslowitz, C.P.A. and partner of the firm Rothenberg & Peters. For decades, our firm has represented individuals, corporations, partnerships, as well as estates and trusts successfully through the maze of the ever-changing tax laws. Please contact us at rothenbergpeters.com. That's rothenbergpeters.com, or call 516-773-3200. The tax return should be the culmination of proper tax planning from the previous year. In 1887, I do not think CPAs could have predicted the complexity of tax laws today. Tax planning is the first step to a well-prepared tax scenario. Please feel free to contact us for a comprehensive tax review. Visit rothenbergpeters.com. That's rothenbergpeters.com, or call 516-773-3200 for an immediate appointment. Hello, everybody. Scott Cheslowitz again, bringing you another session of Tax Talk. I have another great interviewee today. His name is Richard Shane, and Richard's going to be speaking to you about life insurance, disability, and also how to get around getting long-term care when they really don't want to write anymore. And there's taxes involved in almost everything you do. So naturally, I will interrupt for a few seconds and share some of my thoughts. Richard, thank you for coming on the program. Now, Richard, I must say, is a U.S. Army veteran. So hats off to Richard for that. And I'll tell you how I can be reached. Scott Cheslowitz can be reached at www.rothenbergpeters.com, 516-773-3200. Look at my website, see the smiles, and you're going to get top-notch service. Richard, how can they reach you and explain your business a little bit?
Hi, good morning, Scott. My website is Richard Shane, SHANE, CLU.com. And one of my office phone numbers is 516-353-9085.
Beautiful. Now, Richard, let's just jump into this. You know, life insurance can be very complicated. Same thing with any kind of disability policy you might get. There's nuances, and today insurers just don't want to write long-term care insurance. So talk a little bit about life insurance, naming proper beneficiary designations, and the purpose for individuals' coverages.
Let me just start by saying I've been in the insurance industry, mostly the life and disability, and I do have an office that does group medical insurance, also for groups of 2 employees to 100. But the life insurance business has been going through some changes, especially when it comes to long-term care. The big players for long-term care have all dropped out of the long-term care industry. You MetLife, Prudential, John Hancock. And I believe they did because someone goes into a nursing home, the home can keep someone alive longer and longer, thus making the insurer keep paying the $300, $400 a day in indemnity that is required. So they said, you know what, we've had enough. We'll keep our old policies. We'll bite the bullet and keep them going. And we're not going to write any new policies. So a lot of life insurance companies came up with an innovative idea. They said, okay, look, you have this hypothetical $1 million policy, and we'll add on a no-cost benefit that will allow you to access the death benefits for a critical or a chronic ailment and pay for long-term care out of your future death benefit if you need the long-term care.
Yeah,
So,
this is uber important, Richard, if I may interrupt you for a second.
Sure.
Because most people, it's not a problem till it's a problem. people, you need to plan. Just like when I always mention, tax planning, insurance planning is very important. So continue, Richard.
So this way, someone has a death benefit, and they also have the ability that if they need it, to have long-term care paid for, or have a death benefit that if they suffer a critical or a chronic illness, Lou Gehrig's disease, or some type of horrible malady that, or even a heart attack, the death benefit under proper circumstances can be paid, start being paid in advance.
Right, Richard. Let me just say this too. I'm going to segue to something. Business owners, you can buy a plan through your retirement. You can buy a life insurance plan through your retirement plan, and you can make it tax deductible, the premium payments. I just wanted to get that in there, Richard. And at some point, you buy out the insurance policy from the plan, right, Richard?
Yes, but now there are additional features that if a guy or a gal has a life insurance policy in a retirement plan, and let me try and make this clear. They have this $900,000 policy that's part of their retirement plan, tax deductible to the business owner, or the business owner could have it in his own plan. And there are features that will allow that person not to have to buy the policy out, but he or she can surrender it, take the cash value, and there's a provision in some of these companies' life insurance policies that are in a pension plan that for the net amount at risk, they'll reissue a new policy without an exam or a blood test or any medical underwriting.
Mm-hmm.
So if I have this $900,000 policy and I surrender it and I get $200,000 into my pension plan, which thus it becomes taxable, the net amount at risk was $700,000, so they'll issue a new $700,000 policy with no medical questions.
Let me just segue to something else here that's very important. Life insurance is not just for the uber rich. Everybody should realize that. You need to protect your family. So life insurance can also be used as a vehicle to lower your taxes. And what I'm talking about is Medicare taxes down the road. I've always mentioned you want as much tax-free income as possible. So everybody, you can buy a life insurance policy and dip into the cash value the way the law is written today. That's not taxable income because you need to watch the income levels when it comes to paying more Medicare taxes. You agree with that, Richard?
Yes, there's something everybody should be aware of. It's called IRMA, IRMAA, and it's a surcharge on top of your Part D and your Medicare Part B insurance, depending on your income in retirement, and they will deduct that IRMA tax. It was passed in 2015 by the Obama administration, and they will deduct it from your Social Security check. If you're some of the uber wealthy and you have really significant income post-retirement, you could end up losing your entire Social Security check and have to write out an additional check for Medicare Part B and Part D.
Exactly.
Sounds bizarre, but that's just the way it is. It's going to start hitting people next year and the year after and the year after that. So people who are in their late 50s and early 60s who have been fortunate to be very successful can have problems, and they should do some planning ahead of time, like Roth conversions, which are exempt from IRMA,
right,
things like that, and life insurance, which is also exempt from IRMA. And let me just throw in one other thing. People are very familiar with buying whole life or universal life policies that have very little cash value in the very first couple of years. And a lot of people aren't aware that you can buy contracts that, and I'll make up a number, have a $10,000 premium, and you can structure it in a way that the cash value in the first year is going to be $9,500. So if for some reason you need to dip in and take a loan, you've deposited $10,000 with the insurance company, you can borrow 92% of that $9,500 at the end of the very first year.
Now, let me just say to people, it's not only important that you have your various insurances, but you have a planner to make sure you buy the right policies, make sure you get the right tax advice. You need to get your team of professionals together. Before you do anything, you want your CPA involved. And in this case, you want people like Richard. You want to know why you're buying something and what the ultimate benefits can be. Not just somebody who's going to sell you something and go away until they want to sell you something else. Richard, I'm getting yanked off the stage. This was our first segment. My name's Scott Cheslowitz, RothenbergPeters.com, 516-773-3200. Richard, quickly, how do they reach you?
516-353-9085.
Great. We will be
a week, 24 hours a day.
Right. We will be back with another segment shortly. Hello, everybody, again. I cut the music off quickly because there's so much to talk about. You know, I'm here with Richard Shane, and Richard's a wealth of knowledge. I know Richard a long time. So, Richard, let's just plow into this thing here. Before somebody buys their life insurance, they have to define their needs, correct?
Yes, sir.
Okay.
I think it's important to really understand what you're purchasing and what the purpose of that purchase is.
Mm-hmm. That's right. And then you can determine what type of coverage they need. And because there's all types of life insurance products, contracts that are out there. So again, you need somebody who's going to know how to plan for your situation. Everybody's situation is different. Keep that in mind. Richard, you know this as well as I do. Beneficiary designations. Please talk to the listeners about that. The importance there too.
Okay, it's very important to have the proper designation of beneficiaries. Too often, someone, a single parent, will name a minor child as a beneficiary, or a mother or father who are elderly. You want to put some care into your beneficiary designations. If you happen to name a minor child and you pass away, then minors cannot receive money. It's going to end up in a surrogate court judge's hands, and he's going to name somebody as the trustee. So if there's minor children around, it's very important, regardless of your economic level, to have a trust that can name a trustee to take care of the young children that you're leaving these benefits to, rather than having a surrogate court judge appoint someone who he doesn't or she doesn't know who's going to do the right thing.
Yeah.
It leaves the minor children in a bad situation. So what? When they're 21, they can sue the trustee, but meanwhile, the money's gone.
Thank you for that. And also, people, when they get divorced, for example, they don't bother to look at beneficiary designations on their IRAs, retirement plans, and their life insurance policies. So you have to
Let me interrupt for 1 second.
Sure.
Because I had a case like this recently where a woman came to me and her new husband of a couple of years had passed away, and he had a significant amount of money in his 401k plan, and he never changed it from his previous spouse.
Right.
And he left his new wife and their new baby with no funds from the 401k plan, which was significant. It was high six figures, and the ex-spouse received it all because he never changed the beneficiary on his company's 401k plan.
Yeah, so it depends. That comes down to state law, divorce agreements. But listen, the custodian of the plan, only has the beneficiaries as designated. So you want to avoid court battles. You want to avoid squandering the funds in the wrong direction. So it's very important, you keep on top of your plan. When you change your will, you need to look at your policy beneficiary designations, your retirement plan designations. Richard, while we're at it, talk a little bit about retirement planning.
There are a number of issues, and the biggest thing now is people doing retirement planning to have some tax-free income and to move current IRA money, if possible, to Roth designations, because as their IRAs and retirement plans increase in value, the potential taxation is greater and greater. If you look into the future and say to yourself, are taxes lower now or are going to be higher later? If you believe they're going to be higher later, it might make sense to make that Roth conversion now. And you can have in a 401k, Roth 401k money. You can have non-Roth.
Let me just interrupt for a minute, Richard. Now, people, when you convert from a conventional IRA where you got a tax deduction to a Roth, you will be paying taxes on that money you're converting into a Roth. But Richard's point is that I assume that your investments are going to grow within the Roth substantially, and that money will come out tax-free at that point. Whatever the growth is will not be taxable. So you can do that in tranches over time. So bear that in mind. If you have a Roth 401k, any contributions you make to the Roth 401k will still be taxable, be on your W-2. But again, the point is it will grow. It will grow, and that's what you want. You want the growth to be yours. So at some point, Richard, people have to bear this in mind so they can have a smooth retirement.
Yeah, the problem is people are generally surprised by the amount of taxation that is coming out of their accounts once they retire. And they say, well, I put this money away and now I'm losing 35, 40% of it to state and federal income taxes.
Mm-hmm. Yeah, no, I agree with that. And, you need as much as you can get. Social Security right now has not been addressed. And I think it'll be around, but in what form? Because you can't keep kicking the can down the road. So, Richard, disability benefits and hybrid plans for women. Can you discuss that a little bit?
I'm going to come back to that in 1 second.
Sure.
Just let everybody know that there are programs out there that can provide significant tax-free income in the future. If you're maxed out on your 401k contributions, there are ways to put away money, non-taxable, fully taxable, but will provide you with growth and tax-free income in the future. And that tax-free income is significant.
Now,
disability insurance.
Yes, please.
The definitions of disability for white-collar employees or persons having a business who are generally a doctor, an accountant, an architect, someone who's not doing manual labor is usually very strong in favor of the insured inability to perform your occupation at the time of disability. So even if you have to do something else and you have a loss of income, you're still going to get paid from the disability carrier. Most people who become disabled are back to work or dead within 60 months. So most disabilities end in some type of recuperation, even if you're in a bad situation that you're in a wheelchair and you have to get wheeled into a van and you drive it yourself. I have my own cousin who was in Massapequa, had that happen to him. He ended up with MS, but he was able to collect his disability insurance and he got himself well enough to go back to work eventually. It took a number of years, but he did it. He went from Massapequa to Garden City. Disability insurance for women, if you have a small business and you're a woman, disability insurance in general is twice the price for a woman than a man, but there's ways around it. You can have a three-person group. A three-person group is considered, from a ERISA standpoint, sex neutral. so that the three participants all get the masculine rate. And I have one case with a woman plastic surgeon. She put her two assistants on the plan. She went from $11,000 a year to like $4,500 by putting those two people on and getting the sex neutral rate.
Now, let me just chime in here. First of all, when you buy disability insurance on your own, if you're unfortunate to have to receive the benefits, that would be non-taxable. If you buy it through your company, the company pays for it. All benefits are taxable. Richard, we can't tell them everything now. We're just giving them snippets, important ideas for them to think about. And everybody knows you can't learn everything in 20 minutes. Quickly, how do they reach you, Richard?
Available 7 days a week, 516-353-9085.
Beautiful. I'm Scott Cheslowitz. Website, rothenbergpeters.com, 516-773-3200. So long, everybody.
The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting